I went back the other day and I had a look at sentiment out of the agriculture sector versus the New Zealand economy for the past 20 years. And lo and behold, across every indicator, general business confidence, firms' own activity expectations, profit, employment or investment, the farming sector has been less upbeat than the rest of the general economy. The glass tends to be half empty as opposed to glass being half full. I guess at the end of the day, you're still going to need to take a sip. So it's sort of up to you whether you want the glass to be viewed as half empty or glass half full. But if I have a look at one of the big lessons of 2020, let's put things pretty bluntly, thank God New Zealand was one big farm. And we can't lose track of that, because when New Zealand needed the farming sector to be the backbone of New Zealand, go through some pretty tough, challenging bloody times, it was there. And it's going to be a pretty big part of New Zealand's economic future in a world that's changing pretty rapidly. And obviously we know that the challenges that the Minister alluded to, so the opportunities that are put up there in regard to population growth as well. But I'm looking forward to hope that sentiment coming out of the farming sector over the coming 10 to 20 years takes a little bit more of a glass half full attitude. Now there are issues, but the glass doesn't need to be half empty. Just to go back 26 odd years, just to illustrate how much things can change. 25 years ago, these were the top firms listed on the New Zealand Stock Exchange. There is one of them still there, and it's no longer called Telecom. Now that was 25 odd years ago, and that just illustrates how quickly the world has evolved, or New Zealand has evolved, in the past 25 years. And I could put up other things to personify the same thing, but what we know about COVID was just another disruptor. It's a pretty big one. And it's accelerated a whole lot of changes that we knew were going to take place anyway, i.e. working from home, i.e. banks taking the opportunity to shut some of the branches in the rural regions. Now that sort of stuff was going to take place anyway. The big issue at the moment is that we're now, and I've talked about this over the past couple of years, 1 + 1 now equals 11, it doesn't equal 2. Disruption is here and it's coming thick and fast. Whether we look at the incidences of things such as COVID, whether we look at structural change in regard to population ageing, whether we look at demographics in regard to where the population growth is going to come from. The population of Africa is projected to double in the next 30 to 40 years. That is a tectonic shift in regard to what's going on around the globe. The fourth industrial revolution is not like the first three. The fourth is non-linear. It's the digital, the biological, multiple spheres in regard to what are interacting. And one of the big things we've got to shake the tree on across New Zealand is this, Kiwiana 101, she'll be right. We tend to be fast adapters. We'll respond to when disruption turns up at our doorstep. Well, sorry, by the time disruption turns up at your doorstep, odds are you're too late. A survey out a couple of years ago, looking in the rearview mirror, 43% of New Zealand firms have been disrupted. Looking forward, they expected the pace of change to slow because the number went from 43 to 36. Now, the world is fasting, intensifying in speed in regard to where disruption. And this is how we need to respond. Businesses, firms need to learn how to take risk because not taking risk, and here's an oxymoron, is no longer the risk-free strategy. And that takes a little bit of getting used to. What is also going to take an awful lot of getting used to is that we can't just get the private sector, businesses, thinking through that sort of lens. We need to get central and local government applying the same sort of maxim. They need to learn to take risk because not taking risk is no longer risk-free. What do we know about central and local government? They are not good at taking or managing risk, except for of the political variety. Bad policy needs to get put down. Take the political hit, start again. And that's going to be the lesson across private enterprises. You've got to adapt. You've got to change. And when you're adapting, when you're going to change, well, you're going to make the odd mistake. And we've got to be forgiving of those mistakes. But we cannot have the architects of essentially New Zealand's economic framework not understanding how to take or manage risk. What we've got at the moment is obviously a collision on a whole lot of levels, most notably between economics and politics. The share of the economic pie, I'm going to talk about that in a second, but the one that's probably most relevant and worries me at the moment is the whole relationship between what's America and China, Australia and China, and little old piggy New Zealand stuck in the middle. And there was a speech out the other day by obviously a very senior minister that tried to strike a very delicate balancing act between the two. But as we saw from a Tory MP a few nights ago, it's pretty hard to be Switzerland to be neutral in the middle. But New Zealand is trying to be Switzerland and neutral in the middle. We're in an environment where central banks have done whatever it takes. Kitchen sink style economics to get the global economy back on track. I'm going to talk about that because I think we've basically milked the last of that low interest rate cow. We are entering an environment of bigger, more interventionist government. What is that going to look like? It could be good or it could be otherwise. And we, in all seriousness, are going to need the government to step up in the next 30 years because the era of what's called central bank or monetary policy dominance is coming to an end. We're going to need to see a lot more independent research coming out of central government circles. They've got to be able to not just identify problems, they've got to come up with articulate solutions and the ability to execute on them. This is how we're going to need to manage the era of bigger, more active government. Theme 2, for the past 30 years, the trend has been your friend and the trend has been lower and lower interest rates. Now, I think people have underestimated how pronounced, how significant that trend has been in regard to driving a lot of growth. Because if interest rates go down, asset prices go up. You don't need to worry too much about the underlying yield, productivity of that investment. What happens is, as I said earlier, we've milked the last of that cow. Because I've seen in the past, since October, November last year, the yield on a New Zealand 10-year bond has gone up 1 percentage point. Now that's a proxy for what's called the risk-free cost of capital. Now interest rates are still hellishly, some would say ridiculously low. But that suggests to me we're at a turning point. What if the trend for the next 20 to 30 years is higher interest rates? What does that mean for asset values? What does that mean for where we're going to get the growth? It's got to come back to real productive investment. What does this mean for all those property investors that have milked the biggest cow in regard to residential property? Where are they going to need to go if the property market is not going to be the winner it has been for the past 20 to 30 years? I think we're entering a tectonic shift where New Zealand, by hook or by crook, in the next 5 years the penny is going to drop, and we've been talking about this dropping for a while. We need to get more growth out of the real productive part of the economy. And we talk about this and we don't execute it. I think that penny is going to start to drop as interest rates start to nudge up off these lows. And New Zealand still has completely underdeveloped capital markets. If you ever look at the market value of the NZX, it's about 50% of GDP. The market value of the residential property stock across New Zealand is about 5 times GDP. Talk about a mismatch. Now, if the era of monetary policy dominance is over, then we're entering that era of bigger government, which is fiscal policy, government policy. Bigger government means taxes are going to follow the Edmunds cookbook and be sure to rise. Now, that does not worry me if we're getting tangible investment on the other side, that it's going to deliver a long-term payout. But we're going to need independent institutions coming in here, an independent fiscal organisation, to make sure that what's been delivered, we need a bigger, more appropriate accountability structures. Because we are once again in that bigger era of a more interventionist government. Theme 3. For the past 30-odd years, there's been another trend, and the trend has been what's called compensation of employees has been declining as a share of GDP. That's a fancy way of saying workers have got less of the economic pie. Now, workers in this definition includes all the CEOs. But what's gone on in most countries around the globe is that labour compensation of employees' share of the economic pie, it's gotten less. What's driven it? Two things: globalisation, technology, and a third, diminished wage bargaining power. Now, what we're seeing in a lot of jurisdictions around the globe, down here in New Zealand, the thrust of economic policy is about getting that number back up. Minimum wage, fair wage, additional weeks holiday for sickness, additional days national holiday. Now, there's nothing wrong with rebalancing that economic pie as long as you're growing the pie on the other side. Now, this is not just New Zealand. We're seeing this in America. Go have a look at the expectations on Joe Biden. Go have a look at what he's flagging in regard to the increase in the minimum wage there, corporate tax rate. These are global themes where society has basically kicked back and said enough is enough. There's now become too much of a gap between the so-called haves and the have-nots, and we all know that housing has been at the epicentre of that debate. But what is also going on is that there's a furious appetite to get income wages up. Now, that's an admirable aspiration, providing you can get the productivity to match. And at the moment, my fear across New Zealand is that we've got the right aspiration, but we're not matching it by the inspiration to get the productivity growth on the other side. And if I have a look at just a real simple, right here, and apologies for the formatting because this must be a different version of PowerPoint they're running. But if I have a look at New Zealand, the economy in general, and the export sector, primary sector, generally speaking, for the past 20 years has grown about 4.5% to 5% per year. If I have a look at the next 10 to 15 years, the New Zealand economy is going to grow on average between 4 to 4.5. If I have a look at what the government's put out in regard to their aspirational strategy for the rural primary sector, roadmap to a better future, that sort of stuff, the aspirational target, which had a big number of about $40 to $50 billion worth of exports, if you broke that number down, it sounded big. When you broke it down in regard to compound growth rates, 3.4%. Now, 3.4% for the primary sector in regard to growth versus your economy of 4 to 4.5 do not match. And that's just a real simple example in regard to, we're talking a big game, but behind the scenes, when you peel back the onion in regard to what the numbers look like, the numbers don't back up the story. And once again, this is thinking a little bit more about the long game in regard to how we're going to get there. Without the better roadmap, your primary sector exports are supposed to grow at 1.5%. Sorry, 1.9. The additional impetus is another 1.5 to 3.4. Your 3.4 versus 4 to 4.5, primary sector as a share of GDP is shrinking. So much for it being the backbone. Theme 5, pats on the back. Great story over the past, particularly 12 to 24 months in New Zealand across the rural sector, is that, can we call it, getting your house in order. Now, for the past few years, the rural sector, the dairy sector, has been identified as a bit vulnerable within the Reserve Bank's Financial Stability Report. Why? There was a bucket load of interest-only loans. And that's involved some interesting conversations between banks and dairy farmers to come up with an orderly solution. Yeah, what have we seen? That interest-only component has been coming down really aggressively. It's been a great story. What's driven it? The big C, cash is king. Yeah, dairy sector debt's now down to about 38 billion. Yeah, last year in particular, and I think the upcoming sort of 6 to 9 months, we're going to see an awful lot of debt repayment. And it's a great story. So if I have a look across New Zealand at the moment, across most sectors in New Zealand, I'm starting to see more red flags in regard to points of vulnerability. The dairy sector is one of the few sectors across New Zealand where I am seeing less points of vulnerability, because your balance sheet weaknesses have been started to being addressed. And it's happening in a real orderly fashion. Although what we've still got out there at the moment is, unfortunately, there is still a pocket of what banks call non-performing dairy loans. And despite improved cash flow, that pocket of non-performing loans is still about 3%. Now, the good news is that's still pretty low. The bad news is it's still 3%. And that trend has not changed in the last 5 years. And that basically tells me there's a persistent group of basically underperformers, or models that have been embraced that just do not work. So there's still some issues that are going to need to get sorted out down the track. There's another 8% that are defined as what's called potentially stressed. Potentially stressed is basically anyone with the bank that's got a standard credit rating of B or below. Your banks have got different credit ratings, but we use the Fitch, the Moody's sort of definition. Yeah, B's not bad, but C's just around the corner. And unfortunately, there's a lot there with a C in front of them. Yeah, so there's still a fair bit of work to be done in regard to getting the sector back on top. Theme 6, what worries people in New Zealand? The biggest concern across New Zealand is housing. 60% of New Zealanders worry about housing in New Zealand. 22% of Australians are concerned about the Australian property market. Now, if we're in an environment where we've got skill deficiencies, that sort of mismatch between how people are concerned about New Zealand versus Australia has got a net migration outflow written all over it at some stage, if we do not get on top of the property market. And what we also know is that the property market, I think, is having flow-on effects for things such as education. Kids turning up to school. You put these kids in motels, odds are they're not turning up to a school. You bounce them around the rental market, odds are they're not turning up to schools regularly. So everything's interconnected at the hip here in regard to what we need to address. My personal view is that Kiwi Build's not the answer. The policy changes that were announced in March to basically have a crack at landlords, are you kidding me? The losers out of that are going to be the renters. I'm hearing a lot of stories about landlords are going to push up rent, not just because they want to, because they're fearful if they don't do it now, there might be some sort of rental cap that comes in that means they can't. So behavioural effects are happening on the ground. Theme 7, cash is king, and the dairy sector has it. If you look at the financial stability report that the Reserve Bank put out at the end of last year, and the financial stability report that is going to come out in about 3 weeks out of the Reserve Bank, I don't think the dairy sector is going to be a strong focal point. It's fair to say the dairy sector has been a pretty strong focal point in 2018 and 2019. Cash has been king. And economists, everybody's been hoodwinked by what's happened around the globe, including to commodity prices. Who would have thought about 12 months ago oil was trading around zero and now it's around $60? And this is where we've got this complicated web of demand. And the good news about dairy is that China is one of the few countries around the globe of the size variety, in fact the only one that's got decent size, that's got GDP back up above pre-COVID levels. We've done pretty well. We are not back above pre-COVID levels. We're still below pre-COVID levels. China pretty well is back on track. So the demand story has actually come back on board really well. what do we also know is that the supply chain's been knocked around the globe. New Zealand had two big advantages in 2020 that were not openly acknowledged enough. One, we produced food, and two, which meant the food and the world needed to eat, and two, we kept the supply chain open. Now we know heading into 2021 that supply chain is becoming more and more problematic. But by and large, we've got the stuff to go. My personal view is that you're going to see whole milk powder go back from 4,000 a tonne down to around 3.5. It's also interesting to benchmark dairy prices. So if you look at where they are today versus where they were 20 years ago, it's an outstanding story. If you look at dairy prices today, which is the grey line compared to where they were in 2011, the story's a little bit more average. And part of that just recognises that dairy prices have been trading consistently at a higher structural plane for a long time. And they're going to need to going forward because we know the cost structures are going up. If the cost structures are higher in regard to your input costs, you're going to need those commodity prices to be settling at a higher level. Theme 8, supply. Supply part 1 is about getting labour. If you like it, job ads, according to Seek, job ads in New Zealand are above pre-COVID levels. In some regions such as Gisborne, job ads are 150% higher than where they were. Sorry, they're 50% higher than where they were pre-COVID. The only region in New Zealand where job ads are below pre-COVID levels is Auckland. And that is because Auckland is the gateway into New Zealand. So of course Auckland's going to take a little bit more of a battering compared to most other places around the globe. The part of New Zealand where we've got the biggest shortage of people, lowest number of people on the job seeker benefit of the share of the working age population, Queenstown, followed by Central Otago. 1.3% of the population in Queenstown is on job seeker. I've got other regions in New Zealand where job seeker numbers are in excess of 10% of the population. Now that's telling you a structural story. The Reserve Bank came out within their February monetary policy statement and told us we are getting close to what's called maximum sustainable employment, which does not mean everybody has a job. Full employment is where we don't have the job market overheating and risk too much inflation pressure. And here's a frightening stat. There are still 199,000 people on the job seeker benefit, and the Reserve Bank's talking about us being close to full employment. There is 370,000 people across New Zealand on all benefits. That is 1 person in 9 of working age. Now that tells you deep-rooted structural problems that the Reserve Bank does not have the tools to fix those. The tools to fix those, mobilising the labour force from one region to another, you're giving people the skills, has got to come through successful government interventions and policy. And it's only now that people are starting to shine a little bit of light on the story, but it's been around for a long time. 2020, the big story was exports were okay. So exports, the stuff going out of New Zealand in 2020 tracked what was coming in, what was going out in 2019. Imports in 2020 were 7 billion below what they were in 2019. We kept our supply chain open, the world still needed to eat, so by and large export performance was okay. But as COVID disrupted manufacturing facilities around the globe, we just couldn't get the stuff in. What we're seeing a little bit more of in 2021 is that the export story is starting to wilt. And a lot of this is just about supply chain accessibility. There's a whole lot of issues at the moment across the apple industry. It's not just getting the fruit off the trees, it's getting the fruit off the trees at the right time to make sure it's the right quality. I did some work for an orchardist, would have been just pre-Christmas. Went through the numbers, because I said, if I'm going to do the work, I want your numbers. I'm not going to put any qualitative assessment on this. It needs to be numbers-based. RSE workers were 40% more productive than the Kiwis. 23% of the Kiwis did not pick enough fruit to make the minimum wage and needed topped up. Now, the issue with RSEs, the horticulturists didn't mind paying because they got the productivity on the other side. But that's just a real example of using hard data. What does supply disruptions mean? Lower productivity, margin erosion. And the one that worries me at the moment, and we need to be alert to this across the rural sector in New Zealand as suppliers of food. If supply chain is an issue getting stuff into New Zealand, we are seeing importers now thinking about, where can I source alternative supply? Where can I get the stuff locally? Now, if New Zealanders is now starting to have that conversation in regard to stuff that we bring in, you can bet your bottom dollar that other countries are going to be having those conversations in regard to stuff that they bring in. And one of the real big risks going forward is that we're going to see a big acceleration, investment, in effectively technology-driven food. Now, the good news is that the world is exploding in population so much, it should be complementary to the natural produced food. But we're going to see that big acceleration going forward because COVID or the derivatives, the consequences in regard to what this is going to mean for change going forward, we are still in the early stages in regard to how people are going to adapt. But conversations are going to shift. Here we go, what I talked about at the start in regard to school attendance. In 2015, 70% of students regularly attended school. That has now dropped to 57.7%, and that is in 2019. Lord knows what the COVID numbers are going to look like. I initially thought that might be all the year 12 and the 13 kids that are wagging. No, it's not. The biggest decline we've seen is in primary schools. Now, if you're not regularly attending school, what do you think your odds are of being a regular attender at work? Now, the Ministry of Education has described this, and I quote, "It is now looking like a systemic trend." Now, that's pretty strong words, considering the role of education and where New Zealand is going to be 30 years down the track. Have I seen subsequent follow-up? Digging into what's going on, the answer is no. So now we'll roll into what's going on across the likes of the Waikato. Waikato's regular school attendance is 53.3. There's two areas in New Zealand that are worse off the top of my head, are Northland and Bay of Plenty. Now, we're now in an economic model where it's all about people. Yeah. For the past 20-odd years, it's been shareholder top of the pile. And now we're going back to what's called a stakeholder-driven model. And the stakeholder model really takes people back to the epicentre. Yeah, what COVID has highlighted is that we've underinvested in people. Now, this is not just skills development training for the workforce. This goes back to the epicentre in regard to what's going on in the schooling system. So there's an awful lot of stuff. We can't disconnect that stuff, I think, from the housing market. But what we do know is that there's no point not looking at this stuff and starting to have the conversations and make some of those hard decisions. All right, interest rates. Yeah, interest rates are up off their lows, though still low. So New Zealand 5-year bond 6 months ago was 0. It's now up closer to 1%. New Zealand 10-year bond has gone from about 0.6 to 1.65 odd percent. Still real low, but you're starting to see those bank long-term rates are starting to drift up. Once again, they signal turning point in the cycle. Keep an eye on whether the bank manager gives you a bit of a call and wants to talk about your margins, because that could be an interesting one, because I'll give you a stat. 85% of bank funding, that is where banks get their money, is for money that is 1 year or less in duration. Banks sourced $230 billion of their $490 billion funding from overnight money. That is the money everybody's got sloshing around in your transaction and your savings account, and what do you get on that? Zero. So for a big portion of bank funds, funding costs, the marginal cost to a bank is zero. If I have a look at where we're seeing an increase in bank funding costs, and we are seeing some what's called corporate spreads, basis spreads, and a couple of others are starting to widen, so we're watching those, but the bottom line is that bank funding costs are not heavily influenced by those mechanisms. So if anybody sort of starts to get some discussions from the banks in regard to we need to pop up your margin, give us a buzz. Because I'll give you the hard data to have those sort of conversations so it'll be a little bit more of an equal debate. Theme 10, pressure on costs. Yeah, we've been in an environment for 30 odd years where generally speaking inflation's been pretty benign. I've not seen this sort of cost pressure across New Zealand for 30 years. Input costs, wages, yeah, if you're a builder, timber, plumber, plumbing supplies, you can't get the stuff at the moment because the supply chain's throwing it around, so if you want it, you're going to pay up. We're going to start to see it, we already see it in insurance. Lord knows what the average rate bill is going to be when those sort of things get announced, but you can pretty well bet they're going to be some big numbers. And of course the threat is that when you start to see pressure on costs, you start to see a fundamentally different trajectory for inflation, which is the risk for interest rates. For the past 5-10 years, has there been too much inflation risk in the system? The answer is no. Why? Technology, globalisation, outsourcing stuff. Now at the moment, technology is still a massive player in regard to keeping inflation down. What do we also know? Globalisation is getting pressured by what's called nationalism. Bring stuff back on shore. Anybody see the article today in Stuff? Was it $34 or $36 a week of Kiwis' money is being spent on produce out of China that is potentially produced by slave labour? Now that sort of stuff is prodding the whole idea in regard to nationalism versus globalisation. Do the right thing. Now if globalisation starts to reverse, do you think producing stuff locally is going to be as cost efficient? And I'd say hell no. The government's economic agenda is inflationary because it's about redistribution. Now, does this mean inflation is going to turn up at our doorstep? We don't know. But what we do know is that the inflation risk profile today compared to what it was 6 to 12 months ago is a lot more even-keeled. Now, 6 months ago, there was no chance of inflation. Yeah, now, we're starting to see secular forces come to the bear that think, so at the end of last year, I started taking on 5-year debt. And this is not financial advice, by the way. Yeah, I've not done that since 2004. Because I just want a little bit more balance into my portfolio. Not sure inflation is going to turn up, but it's now a risk. And I operate through a risk management lens. Theme 11, the Minister talked about this in regard to the gas emissions. I saw middle of last week, Russell Norman got on, I think, News Hub and said agriculture was responsible for 50% of New Zealand's emissions. Well, technically he might be correct, but we both know there's a big difference between long-lived gases versus the short-lived. And that was a real problem to me because it's basically using data to tell a narrative that's not quite accurate. Everybody here, get out there and go read the climate change report. It was actually really positive in regard to what it said about agriculture. Yeah, pat on the back. Jim talked about it. The Minister talked about the progress that's been made over the past 30 to 40 years across the agriculture sector. There's been a lot of good stuff that's actually going on. I wrote an article in the Stuff newspaper, would have been mid of last year, which is probably one of the most popular articles I've written, and I sort of threw it out there that says, imagine if we had the household equivalent of a farm management plan. would that drive a big change in household behaviour in regard to how they managed their own risks in regard to the environment? And as a theme at the moment, that has not been talked about. But this is where the conversations actually need to go. Yeah, when I did the roadshow for the dairy sector start of last year, the fog was starting to clear, then COVID rolled in and the fog sort of descended again. Yeah, the dairy sector, the farming sector, basically sort of knows what you need to do. You've got a bit of a plan about it, and we're going to get there. Where the narrative, where the discussion is a country mile away from taking place is across the broader New Zealand economy, and particularly into the cities. And jokingly telling people we need a household environmental management plan was just a quippy way of saying let's get a little bit of sense and sensibility and fairness into the whole debate. The Minister talked about transforming the economy. Yes, we are going to need to transform the economy. The last time we transformed the economy, or tried to, was the mid-1980s. It did not go well. And the reason we did not go well was twofold. Look, one, we left it to market forces too much. And you need market forces, but market forces is like having no referee on a rugby game. It's like expecting cricketers to walk voluntarily. What we know is that they cheat. So there is a role for the referee for government involvement. But it's a question of getting a little bit of sense and sensibility. And the government is going to need to it's going to need to step up very big in the next sort of 10 years to help make sure this transition takes place in an orderly fashion. There are going to be jobs that are going to be displaced. We're going to need to wrap cotton wool around these people and get them back on the front and narrow in regard to into the workforce. And the Minister talked about the climate change report. Their numbers has not been too bad. My personal view is that they probably, in the absence of a big step up in government policy, they're going to underestimate the displacement effect. We can minimise that displacement transitional cost if we get good, well-reasoned economic policy executed well on the other side. Final slide, old versus new. Old model, what used to be called shareholder capitalism. That was just about making money in the near term, capital gain. New model, stakeholder capitalism. Communities, people. Long game versus the short game. I guess the way I think about stakeholder capitalism is it's pretty heavily in tuned, I think, with the way the rural sector is. You're guardians of the land. So there's nothing new here. All we've done here, we've put a fancy new term on it. That's economists for you. Old, monetary policy dominance, the Reserve Bank, interest rates, magic wand. Now we're entering that era of big government. Could go well, or it might not. Challenge has got to be to execute. I don't mind paying more tax. One caveat, I want to see delivering results on the other side. And that's where we need the accountability going forward. Interest rate lever, no, that thing's busted. Now it's about financial stability. How we regulate the flow of credit as opposed to the price of credit. Asset price wealth strategies was old. Now it's about real productive strategies. And we've talked about this for a number of years in regard to getting attention back to profit. Well, that movement up in long-term interest rates, the cost of capital, tells me we're in the early stages of that 5-year inflection point. The penny's going to start to drop. Lower taxes was the old story. Now it's higher taxes. You've got to feel sorry for those landlords. They were just a scapegoat. But the government's going to need more money going forward, and they're going to go looking at sectors to provide it. The challenge is to make sure that they're delivering on the other side. Old game was about thinking big, now it's about thinking small. Microeconomic policy, all those little levers. Don't worry too much about the bigger picture stuff, it's beyond your control. Low government debt, rising government debt. That is going to be a tax on the future generations. There's nothing wrong with borrowing, particularly when interest rates are low. But we've got to be getting value on the other side. Most of the COVID money went on operational spend, very little went on shovel-ready projects. The shovel-ready projects were a mirage. They have not turned up. And now I see that a whole lot of those roading projects are now under threat as well. So there's going to be some tough decisions going forward in regard to where we're going to be financing this from, including local government. We've been used to an era of low inflation, sub-2, low costs. A gentleman came up to me early on and asked me, are we going to enter a period of hyperinflation? I think the answer is no. Are we going to enter a period where inflation is going to be consistently above 2% for a while? I think the answer is yes. Now, central banks will let that run for a while, because after undershooting, having inflation so low for so damn long, you're not going to get spooked by a little bit of inflation. Issue is, it's a fine line between a little bit and a little bit more. Thank you.
We do have time for a couple of questions, so if our roaming mic people are ready. Any questions from here? Coming to you.
Yeah, Murray Holdaway. Thanks, Cameron. It was a great address. If any concerns about it, just had too much information in there really to take it all in, but great address. You started off by suggesting that the dairy industry needed to be more positive, and then gave us a whole lot of reasons why we should be hanging, I guess, but we are the ones shining light really, which is your message. My question is, given the COVID and not only our response, but response from governments around the world to print more money, and given our propensity in New Zealand for natural disasters, you know, how are we placed now to deal with another natural disasters? And I mean, what is the effect of just continuing to print money?
Right. First question, how are we placed right here and now? Pretty damn well. Yeah, net government debts, depending when you include Crown entities, because they tend to put stuff off balance sheet to hide the true numbers. Yeah, government debt's around 30-35% of GDP, which is world class at the good end of the spectrum. It's going to be closer to 50% of GDP by 2024. Now, 2024, 50% is still low compared to what we're seeing in America, which is around 100% of GDP. But you hit the nail on the head here in regard to New Zealand's got a lot more economic risks about it than other countries around the globe. You know, so we need a little bit of money, or that rainy day money, in case we go through another tectonic shock. And what we do know is that adverse events tend to come around every sort of 10 years. So there is going to be some attention to putting money away for that next rainy day. Is now the right time to be doing that? The answer is no. Your fiscal policy needs to be supporting the economy in the near term. But eventually, we're going to need some really tough decisions that are going to need to be made. And the issue is that will the government of the day have the guts to make those hard decisions? The second thing in regard to inflation, Japan's been printing money for an awful long time and inflation hasn't turned up. And one of the big reasons for that is that we've been in this global environment internationally where technology, globalisation has just been the predominant theme in regard to keeping inflation basically disinflationary as opposed to inflationary. Now, Economics 101 is if you print money, you're going to see inflation at some stage. Economic 101 has sort of been diverted by those other things. What we know is that those other things are not quite the inflation suppressants that we've been used to for the past 5 to 6 years. So the inflation risks are not a lot more heightened than where they were 3 to 4 years ago. But the jury is out globally. I've got some people that say we're going to see a lot of inflation. Other people just say, no, inflation's dead and buried because of technology.
Thank you. Questions from Southland, Ollie? Any questions?
There isn't one coming from the floor, but I have recognised a familiar name just coming out of the Q&A with Slido. So question coming through from Paul Marshall is, Cameron, what risk do you see the government should take with child poverty?
So what risks?
Yes, correct. What risk do you see the government should take, or where should it be looking to try and address, I suppose, trying to reword it, with regards to child poverty? Are there certain areas that they could be doing more in, which could be perceived as riskier?
Well, there's no magic bullet that's going to make child poverty go away. But what we do know is that we're going to have to be hitting a whole lot of areas. Yeah, housing across this country is a disgrace. When you go down to Napier Hastings, there's something like 1,200 people in motels. Now that's just accentuating poverty. So we've got to get the houses built. Now, some of the stuff that came in on March 23rd in regard to the infrastructure fund that's going to help local authorities is actually really good. Investing in skills, apprenticeship-based trading so we can build the houses, that's really good as well. There's a lot of attention at the moment in regard to putting money into people's pockets. Should we lift benefit levels? I'm not convinced of that. Should we lower abatement rates so people can get out there and make more money without getting their benefit abated? I'd probably go a little bit more down that route. I'd be a lot more proactive in regard to giving people money so they can shift from regions where there are the jobs. And maybe we need a little bit of the carrot, but that to be matched by the stick on the other side. I think the education is an area that doesn't get enough attention. Yeah, why the Ministry of Education has not put out a working paper in the last 12 months explaining why regular school attendance has gone from 70% to 57.7 is just beyond me.
Thank you. Thank you very much for your time, Cameron. Always a great update on what's going on. Thank you.